All right. Hello, Anna. Thank you so much for joining me on the Flipping Junkie podcast.
Hi, Danny. Nice to be here with you.
Oh, thanks. Why don't we get started by sharing your story, how you got interested in real estate investing, and just give us all the details. Go into as much detail as you'd like and let us know how you got into this.
Sure. Well, my story actually started way before I was born. My grandfather he was living in Tampa, Florida, and he was in real estate, and he saw that something was happening out west. So he sold everything he had and moved to Southern California. And when he was in Southern California, he started there with not very much. And how did he start in real estate? He started by flipping houses.
Nice.
So my grandfather was in flipping houses in the 30s and 40s, and
Wow.
then he built up, um, amassed enough money and wealth that he eventually and experience. So he started buying plots of land and building commercial properties on it. So when I was a child, my grandfather, there was a big billboard that was like "Ask Bob Simons," and he was like the guy,
Wow.
and we had a commercial real estate office. We had like shopping malls because he had bought like walnut groves and orange groves and built shopping malls in the
Wow.
50s. So the fabric of my life was caught up in commercial real estate. I'm the youngest grandchild, so that was all developed before I was born. My father's an architect. My two uncles are, construction, and the whole family was real estate, commercial real estate specifically. But he started out as a flipper, which I always thought was very, very interesting.
Yeah, that's amazing. That's a first. I don't know that I've heard anybody speak about anybody flipping houses in the 30s and 40s.
Yeah, and it was in the San Fernando Valley.
Yeah.
So if you don't have much, you start out that way. And he used to rub elbows with the Hollywood stars, and there's all kinds of stories of
Oh,
him
wow.
interacting with the people. So pretty exciting. But I actually didn't go into real estate when I was a kid because everybody my whole family was in it. So but I loved problem solving. I was always into puzzles and problem solving. And so computers were coming out pretty big then. And I ended up actually having a child very young. So I was a teenager and I was out of high school, but very early into college, and had a child. I was a single parent and I needed to make money.
Hmm.
And my dad said, you should consider computers. So I became a programmer. And so I continued, put myself through college, actually my undergraduate and my master's degree, pursuing programming and computer science. And that's how I was able to make a really good hourly wage and support my child and go to college. So I didn't go into real estate out of necessity. I needed to make a really good hourly wage. But that ended up going really well for me. And IT was a great career, especially in the 80s and the 90s. It was really booming. So it was a really great decision. I became a systems architect, and I was kind of like top of the heap on big companies. And I always worked for myself because I grew up with that entrepreneurial spirit that my grandfather had. And again, my dad was an architect. He had his own business. It's just kind of the way we roll.
Mm-hmm.
So even though I was working at big companies, I was working for myself. So then what I've learned, so actually the IT industry crashed in the year 2000. I'm not sure how many people know that, but there was a big crash in
Yeah,
2000.
real big one. Yeah.
Yeah. And both my husband and I, because I had gotten married and had another child. And so both my husband and I were in IT, and it hit our household really hard. So I decided at that time we were overly invested in IT. So I actually decided to start my own business in something else, which is something I always wanted to do, and I became a photographer.
Really
So
interesting.
yeah. So here
Yeah.
I was in the Bay. I live in the San Francisco Bay Area, and I, already had a lot of business experience. So I started a photography studio and became a very successful photographer in the Bay Area. But what happened, and what I realized, and I already was facing this problem in IT, but it multiplied even more with photography. When you're really good as a business person, you end up having this huge problem where you're paying way too much taxes. And I'm sure in the flipping industry, a lot of you can totally understand that. You're making all this good money, but all of it's going to paying taxes. So how do we deal with that?
Yeah.
So what I realized is going back to real estate. That is how, because again, my family has a lot of experience in how to avoid, how to take advantage of the loopholes that real estate affords us. And so that's what I started doing and investing in rentals.
Hmm.
And I was able to get my tax situation under control
Yeah.
through real estate. I then realized, hey, it's not just about taxes. What I'm doing is actually very non-scalable. Here I am doing as a photographer doing this job that it's all me, and there's no way I can scale this. So I made the decision to go real estate full time, kind of go back to my roots, and made a 5-year plan to exit my photography studio and become a full-time real estate investor. And
Wow.
that is what I have now accomplished. I'm about a little over a year into having closed down my studio. And since closing down my studio, I've learned, and in that 5 years, of course, I've learned quite a few things. I am not a flipper. I am a buy and hold person. I started out in single family, some small multis, but now I'm all about major multi. So big commercial real estate. That is what scales to me. And as a numbers person, that is what makes the most sense to me. So I take my data science background and my programming background, and I apply that to how I acquire and how I manage my real estate. And
Nice. Yeah.
I've really been leveraging that because of my business partner, who I met about a year ago, Neil Bawa, and I took his boot camp class. And in that class, I really learned about the power of multifamily. And he was looking for somebody to help underwrite properties. I started volunteering for him, and kind of it was just a really good business match. We started working together more and more. Since we started working together, and I became his business partner, and I'm now vice president of the company, we have acquired together 793 units. 5
Nice.
buildings in 3 different states. So it's been a great start,
Yeah.
a very strong start of my real estate investing away, completely 100% of my time. And we've been doing some great things.
Wow. So as much as you wanted to do something else, you were pulled into real estate anyway.
Yeah, and it goes back to problem solving. I love problem solving, and real estate affords me that opportunity too.
Yeah.
So I feel really blessed to have had what I consider, this my third career in my life, and I think that's the best life to live, where you really continue to challenge yourself and reinvent yourself.
Hmm.
I that's just something I enjoy the pivot, and I just did a big pivot, and it's fun. It's working out great. But I take with me all the things that I was before. So what I am now as a real estate investor is benefits from all of the
Hmm.
experiences I bring with me in my life.
I love that. Yeah.
Yeah.
No, that's very inspiring, actually. To go and change things like that, in big pivots takes guts. People get stuck in what they're used to and not wanting to get out of that,
Yeah.
and you've done it. And like you said, using all of the things that you've learned in the different, businesses that you've been in, has helped you where you are now. So that's great. And I know about 2000 because that's when I graduated college with my computer science degree, was in 2000.
Oh, that was not a good year, huh?
But no, it was a really fun time, right? Because,
It was, but the 90s were like so banging for IT.
yeah,
And then, man, it was hard for a few years there, huh?
yeah, yeah.
Yeah.
So, but here in San Antonio, we have a lot of defense contractor stuff. So that's where I got a job. So it wasn't too hard to find a job. Well, and obviously, I don't think it was ever, even with the crash, like it wasn't really that
Yeah.
hard to find a
Yeah.
job.
Computer science background is useful for every career throughout, your life. And, having those skills that you can never lose with those skills. And as a programmer, I mean, I still consider myself to be a programmer. I'm program every day. It's problem solving. I'm always, creating different interfaces and doing and number crunching, because I'm the lead underwriter for the group. So
Yeah.
I'm always looking at, I get all kinds of spreadsheets that come in, deals that are presented to us, and I have to dig in and understand those spreadsheets and figure out if, first of all, is the spreadsheet telling the truth, or the numbers or the formulas correct, and then figure out if it's a good deal.
Yeah. And there might be people thinking too, wow, you went from computer science to photography.
Digital photography. So there it was,
And to real
yeah,
estate. And it's like, that's a very odd sort of pivot, but I don't think so because,
yeah,
I know, like you said, with the computer science, that is a very creative thing to be able to wrap your head around abstractions and just have a million ways to do something.
right.
You can be super creative in it. And that's why I loved it too.
Yeah, I actually was specialized in user interface as a user interface architect. And because I was able to program on the back end, I could visualize how the interface of the computer would be with a human being and what was the best way to interact, and then how to program that on the back end.
Yeah.
And if you think about, photography is really an extension of that. A camera is a very technical thing, and lighting is very technical. So I was using, just bringing it to another human level, right? To interact with human beings and kind of capture who they were. Because I'm a portrait photographer. And the same thing, just like I'm still a programmer, I'm still a photographer.
Yeah.
No one can say I'm not a photographer. I have just the same skill set I had 3 years ago in photography. And, I just don't do it to make my daily buck because it's not scalable. And I want to live a life that I have much more freedom over my time. And I, have a future that is more promising. That is what real estate is giving me, is the ability to scale and the ability to control my time.
I love that. Yeah. Looking at things in terms of that, what is scalable? What are you going to be able to do that's going to be able to bring you, income over time after doing it once, and maybe some slight maintenance for something to keep it all going, but you don't have to keep working to get where you're just running, on this treadmill.
Right. And that's what I love about multifamily too, because it is, from my analysis of the real estate industry, it is the most scalable. There's just no doubt about it. When I used to do single family, because I was kind of, I think that reason I did single family and small multis is because I was concerned about, I didn't have the money to buy big commercial real estate, first of all. And I'm like, well, how am I going to do that? I don't see how that's going to work. I don't know people that I can use their money. And then the other thing was I kind of just wanted to just do it on my own, just me and my husband. So those are two things I had to get over when I started going into, when I realized that multifamily was so scalable. I had to realize that multifamily is best done in a team. It's a large animal. It's a large beast. And you need to approach it with a team of skilled people that bring different skill sets with them. And there's nothing wrong with that. Mm-hmm. I actually really enjoy working in a team. So that's the first thing I had to get over. And then the second thing I had to get over was that using other people's money to acquire an asset that is going to it's going to deliver good returns. That's not a bad thing. That's a good thing for many people, because those people they're able to provide money to a deal that they don't have time to asset manage, and they don't have the experience to find those deals. So it's really a win-win situation, as long as you, as the deal sponsor, understand the incredible responsibility you have to shepherd those people's money. And as long as you're on task and you're all in, it's not a problem at all. It truly is a win-win for everybody involved.
Yeah, nice. So I want to ask you about the team thing.
Yeah.
Being a developer, and I think a lot of developers, most of the ones I know, are really like to work by themselves, right? They like to originate their work. They like to work by themselves. Getting them to work as a team is a big challenge. And usually it's giving them components and things that they can focus on solely and then hook up with other people. And that's the way I feel I am too. Like, I like to originate my own work. I don't like working for somebody else. I don't like, I don't know. It's really hard for me to work as a team where I'm having to collaborate on one thing versus being one part of it and then working as a team. So how did that transition into a team for the multifamily? How did that work for you? I mean, what kind of people are on the team, and then how do you guys work together?
Sure. Well, again, I'm in the San Francisco Bay Area. So one of the things that I don't have is good deals near me, right? So the most obvious thing is I need to partner with people that are in locations where there are good deals. Because what do I have that those people don't have? I'm in a location that has great access to money. You can throw a ball and hit 5 accredited investors in the Bay Area. I mean, because, just the normal person is accredited here in the Bay Area, because we have to be. It's so expensive to live here. So I live in a place where there is a lot of capital available, but there really aren't any deals. So that's a really good example about how you can take advantage of, like, I've got something you don't, you've got something I don't, let's get together. Plus, not only is that person where the deals are, but when we're buying out of state, which is what we do almost all the time, we need what we call boots on the ground, because this is a long-term project. And in order to be responsible to run that asset, we need somebody to live in that community or be contractually obligated to visit that building every 2 weeks. And so they need to live relatively close because we don't want a large travel bill every 2 weeks to add more burden to the property. So it's important. That's one thing that that person can do. Now, not everybody's great at numbers. I mean, I happen to be, like, I'm a numbers, I'm a detail person, but everybody's kind of got, what I call their own superpowers. And when we all come together, kind of like, what are those, all the superpowers that have, it's the group of them, and they all bring their special sauce to it. That's the way I like to look at it. And it just makes us a much more powerful group together. But I did, like you, had to get over the idea that I don't want to control everything. I don't need to. I just need to trust my partners. Of course, we're very picky about who we partner with.
Mm-hmm.
And you do need to be very choosy.
So how do you do that though? I mean, how do you guys, like, they're bringing you potential deals, right?
Yes.
Because you have the money and
yes,
the expertise.
we have equity. And we stay on the deal as equity partners. So it is a relationship that's a long-term relationship. It's at least a 5-year hold. So let's assume it's a 5-year project at the very least. If it's an opportunity zone project, it could be an 11-year project because we're very involved in opportunity zones as well. So, we definitely, just like we vet the deal, we also vet the potential partner. So we're going to look at their background. Of course, we're looking at their resume. We're looking at, people that know them to get referrals. What have they done? And we're also really doing a gut check on their kind of ethical being. It's very important to us that we partner with people who are very, very ethical, especially because we are the ones bringing the equity. And so it's really important to us that these people are very grounded, and that we can, as a group, make decisions that are going to be the right decisions for the property, for the investors, and have the right order, the right priorities.
Yeah. And have you come across anybody that wasn't very ethical, that it was pretty obvious, and like an example?
Well, it's hard to give.
Everybody's going to say that they're ethical, right? You don't just ask them, are you ethical? And they say yes.
Well, it's according, when you're looking to partner on a 10, 20, $30 million deal, there's a courtship that happens, so it doesn't happen overnight. We might have met these people at conferences or meetups or something, or somebody introduces us. It'll take a few months. We don't just meet somebody and immediately partner with them, because how can we know who they are? Right. And it is so important. I mean, you can look up a lot of stuff on the internet, but you really do need to get to know a person over time. I would say that we're currently blessed, and I hope that we continue to be blessed, that we really love all of our partners, because I'm on weekly calls with them. I just got off calls from our Dalton, Georgia property. I'm getting on calls with our Jackson, Florida property. Sorry, our Dalton, Georgia. Yeah. So I just love all my partners. They become like really good friends, and you've got to be able to work things out together. You got to be able to talk about difficult things and not have people's egos get so big that they're going to take up the room and no one else can be heard. But one thing that we always have as partners that we bring to the table is we bring the numbers. And we always say the numbers don't lie.
Yep.
So you can't argue with numbers, right?
Right.
We are all about measuring everything. So there's the acquisition, which obviously you've got your underwriting model, and that's all numbers, right? And we're projecting the rents, and we're projecting the expenses. We are projecting that these are the returns. But once you actually acquire the project, that's when the real game starts. Now you've got to run this business. It's a business. And so we have, of course, a property manager in place, but we are asset managers. So we're managing the managers. And so they have to deliver up metrics for us. We have specific dashboards that we provide them, and they, on a weekly basis, have to fill in all this data for us that gives us kind of a dashboard of the property, so that we understand, the occupancy, the delinquency, the expenses, all that type of stuff. So when you were really able to look at the numbers, there's not much people can argue about, right? Because the numbers are the numbers. So that's always been, how can you argue with that?
Yeah. So you trust, but do you verify? I mean, is there a way that you verify the numbers that they give you?
Oh,
other
that the
than
property
how much
managers give
revenue
us?
generated?
We
Yeah.
do. We have various ways of auditing. So that's always part of our system. So one of the special things that we bring to the plate is that we have what we consider an army of staff that we have in the Philippines. So we have a lot of people that are in the background that are doing that. So we actually have the manpower, so to speak, to do auditing because
Nice.
we have these people in the background. And so a lot of the reports and the metrics that we're driving and the auditing that we're doing are these people that are working with us. And, you know, they're not coming at anything in a hard way and saying, yo, you didn't do this. It's more like, hey, here's our auditing report. We noticed that you're showing this and we're showing that. Could you explain the variance?
Oh,
Could
yeah.
you explain what's going on? So everybody gets to know, like, oh, I've got to be on top of my game because they're really, you know, and sometimes it's innocent, right? Somebody makes a mistake, you know, they don't realize, but once they know people are watching, they're like, okay, I better make sure this report is accurate because they're coming behind me and they're going to check.
Right.
And again, everybody understands that if it's good for the tenants, it's good for the investors, it's good for the property manager, it's a win for everybody. So there's no circumstance where if it's good for me, it's bad for you when we're working together on a team, right? So again, that's kind of an underpinning of the project is that we're all winning together, and we're all trying to drive this in a way that's ethical and responsible, and you know, so it feels good to be able to work as a team together.
That's awesome. So let's get into the analysis part of it for these deals.
Sure.
Obviously, it's a completely different animal than flipping, wholesaling, rehabbing, all that stuff. So
we do a lot of rehabbing.
What's that?
But yeah, we do a lot of rehabbing,
On a much bigger
we don't
scale.
sell it right away. But yes.
Yeah. All right. So we have, you have marketing analysis, you have underwriting. Let's start with the market analysis to see where and how you choose what are good properties.
Sure. So again, because we don't live in the markets that we choose, how do we know what a good market is? Well, we apply data science to locate our markets. And we also teach multifamily and how to buy apartments. So my business partner, Neil, has kind of boiled it down to specific numbers and, how do you go about looking at it? So we encourage people to use citydata.com. You can find this information in a lot of different places, but CityData is one free source. So one of the major things we focus on is population growth. And we're not just looking at population growth like since last year, has anybody moved here? We're looking for long trends. So for example, we're interested in, if you look at city data for a city, you just Google that city and it'll come up in city data. We're looking for what is the population growth since the year 2000. So if you Google the city, actually the population growth is not in city data anymore. So I stand corrected. The population growth is actually, you just Google, city population growth. So San Antonio population growth, and it will come up within Google. And then there's a little slider that you can slide back and forth. I see you doing it now, huh?
Yeah,
I see you pulling it up.
Curious.
Yeah, good. So you should probably see it in front of you now. And then there's a slider and you can pull that back and it's going to show you two other cities that are close to San Antonio as well. So pull that slider back and look at what the year 2000 was. And then you can slide it forward and see what the current year was. And ideally you want the population growth to be 20% between those timeframes. Okay. What are you seeing for San Antonio?
Yeah, it's the Google's not showing me a slider or anything directly on search.
Well,
so I'm gonna have to go into a site, but.
Okay. So now, of course, different cities are different sizes, right? So if the city is between 250,000 and 1 million in population, that's where you want that 20% population growth between the year 2000 and the year 2017. Now, if the city is over 1 million, then you're looking for 15% growth. All right. If it's over 2 million, then you're looking for 10% growth. And then if it's under 250,000, so a very small city, then 30%. But you get the idea. So you're looking for significant growth. All right. The other thing we want to look at is job growth. Okay. We're all about the jobs because now we're, being that we're not flippers, we need to make sure that the people that are living in our apartments or our units have a job. They have jobs available to them. So clearly jobs are very important to keep people there. And I would think it's important for flipping as well. So for jobs, that's you're going to look for, there's lots of different sources for it. We look at the departmentofnumbers.com and you can look for the city there. And so we're looking for numbers that are 2% above 2% annualized job growth. So if the city's over 1 million, then 1.5% is good. So that jobs, again, are
Department of
very
Numbers?
important.
You said
Yeah,
Department.
DEPT, departmentofnumbers.com.
Okay.
And then, so departmentofnumbers.com/employment/metros is where you find it. And I can actually provide information on how to get this data that I'm telling you, and how to find it easily, and actually how to walk through how to use it.
Yeah, we'll put that on the show notes.
Yeah, great. So and again, it's free. What I'm suggesting to you, and what it's all free. So it's nothing that we're selling. We're just providing knowledge.
Okay, cool.
So crime is obviously very important. So you want to look at crime levels. For this, you're going to look at city data. So you're going to look at citydata.com and look up the name of the city. There's lots of places you can look at crime, but this particular example I'm giving you is city data. So in city data, you're going to scroll down to a table towards the bottom, and towards the bottom is the crime. You're going to look all the way over to the right-hand side, the right-hand lower, and that's going to show you the current crime levels, okay? Because it's organized by year. The year, I don't know if it goes back to 2000. It goes back pretty far. But the most current year is going to be all the way over to the right. So you want to make sure that number, as best as possible, is under 500. Areas that are over 500 are really, really high crime. The other thing you want to do is you want to look now, after you look at that number to the far right, you want to look over to the left, and you want to see that the trend from left to right is going downwards. Okay. So if you had, say you had the number 400 in the far right, you might say, yeah, ding, 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 it's under 500. But if you look to the left and you see that it used to be 200 and now it's 400, that's not a good trend.
Yeah.
So you need to understand the context of that number. Now, we also are looking at the median household income. That's, again, important to us because we're looking at renters. And we're looking at one thing, we're looking for apartment buildings that aren't going to have too much delinquency. Delinquency is when people don't pay their rents, okay? So when you're looking at median household income, you're making sure that you are in a neighborhood that people can actually afford to pay their rent. Because if people aren't making enough money, then you won't get paid rent 12 months out of the year. You might only get paid rent 7 or 8 months out of the year, and that really doesn't help anybody, right? So we're going to look at the median household income, and we want the median household income growth, because you're looking for growth in a city, to be 30% between the year 2000 to the year 2016. Again, you're going to use citydata.com for that. So they're going to have both of those numbers, median household income in the year 2000 and the year 2016. You're looking for 30% growth, okay? House or condo value is also something, and this is good for flippers, I would think, because this is going to give you an idea about appreciation in a market. What is a historic appreciation? This is also on citydata.com. Similar to median household income, you're going to look for median house or condo value. And you're going to look at from 2000 to 2016, what is the difference? And you want that to be 40%, okay? We want 40% growth in median house or condo value between the year 2000 and the year 2016. So let's see.
Now with the crime data, you had talked about, looking at the metro. Do you guys also zoom into where this project is and look closer in to make sure? We
do. It's a great question.
It could be different over.
It's a great question. So what we do is we look at the overall market when we're looking at a property. So we look at the metro, and that's where we're going to get those big numbers about population and job growth and that type of thing, and overall crime. And then we look at the micro neighborhood. So we might really like the metro. We're like, yeah, Atlanta, man, you are happening. Or, we have a lot of metros that we like. But then I'm going to look at the micro neighborhood. And that's where I want to make sure that my median household income is what I want, that my the crime levels are down. I'm going to, be looking at, the lots of different information that's right in that neighborhood. Yeah. One of the things we look for is actually the ethnic mix in a neighborhood. And we look at that because we, we're operating large apartment buildings, and we want to have a lot of diversity. Diversity is a really good thing, because if you have only one type of thing in that neighborhood, whatever that, shade or type of anything is, then your audience is smaller, because anyone that wants to live in that neighborhood is only one type of thing. But if you have more diversity, then more types, that's going to be more inclusive of more types of people to live there. Now, of course, if it's in a state where you only have one type of thing, that's, what are you going to do?
Yeah.
But overall, in general, we like diversity when we're looking at that micro neighborhood. We're also going to be looking at, in the micro neighborhood, we're going to be looking at unemployment. So you don't want to end up in a pocket where the unemployment is incredibly high. So how do we know what's high? For, of course, there's the national unemployment level, but that's not really accurate to compare it to the national level. So what you do is you're going to look at what is the unemployment rate for the city. So once you know the rate for the city, you want to make sure that the micro neighborhood unemployment rate is within 2% or two points of that. Okay. So you don't want to be, if the city's at 4, you can be, as much as 6, but you don't want to be at 8 or 10. I mean, there are some pockets where you're like, wow, this looks like a great deal. And then you look at the unemployment level and the poverty level and you're like, holy Moses, this is.
Oh, that's interesting. Yeah.
Yeah. So the data will tell you so much stuff about this. And I actually have a way that people can get this information. You can add this to your thing, but if you text RE Toolkit to 44222, then you can get all of these things that I just told you, like, written out. And again, there's no like money, it's no money related to it. So it's just RETOOLKIT. And then there's also a whole bunch more reports in that directory that you'll get this information. We put all of the reports that we use monthly to keep on track on top of all the data nationwide. So we're always looking at the rents, multifamily rents and lots of commercial property stuff. So it's an ongoing repository of information. And then you'll get the this data that I just gave you about what should each of these things be. And then you'll really be able to look at a neighborhood and understand it so much better using free tools.
Yeah, I like that.
Yeah.
Yeah, even if you're doing single family rentals or something like that, it's good to know.
Oh, it all applies. Yeah, it all applies. You want to make sure that you're in a neighborhood, again, where people can afford to pay the rent, where people want to live, and then, where it's path of progress. You want to be living where the income is improving versus the income is declining, or the population's, declining.
Right.
So all of that stuff's in the numbers, and it's all free out there. It's just knowing, how should you look at it? What are the most important things to look at?
That's the big thing. And I think that's what's most beneficial about what you've shared is it's not just what the KPIs are, what the metrics are, but it's like which one is good, right? Because you can have all the data in the world, you can have all the KPIs in the world, but if you don't know what is good, it's not useful for the most part.
And of course, the KPIs that I just shared are relevant for finding tenants, right? If you're looking for flipping houses, you may want to adjust some of those KPIs, right? So that you're looking for something that you're focused on appreciation, because you're looking for people that are going to be buying houses from you. They're going to live there versus be a tenant. So just when you're looking at what I've presented to you, put that hat on and say, well, okay, she's talking about tenants. I want somebody to buy the house, live here, raise their kids here. What do I think? How would I adjust these numbers to make that relevant, for a flipper?
No, I like that. All right, great. Yeah, so that's, we talked about market analysis. Do you want to talk about anything regarding underwriting with these properties?
Sure. I can dive into underwriting a little bit.
Not into anything too technical, just some quick general rules.
Okay. So when I'm looking at a property, people bring us properties quite a bit. The very first thing I do is my demographic research. So I don't even step into underwriting until I've looked at the overall market and then the micro neighborhood. So let's just establish that right away. The numbers mean nothing to me if the neighborhood's not right. I won't even look at the deal. So what do I look at? I'll just, some high level things that I look at. Again, this is going to be relevant if you're holding on to a deal. Of course, I want to look at rent growth in the area and whether, rents are increasing or not in the area. So that's something you need to understand, how fast rents are growing, kind of look at the historic rents. I also want to look at the delinquency in the area. I want to understand what's called bad debt. So at what rate, what is the percentage of people in this market that don't pay their rent? Sometimes you can be in an area where it's really high, where it's like 4% of your rental income is not going to be paid. And then it's a real problem. It can be, and then, so, and then of course you need to understand from that standpoint, you also need to understand what are the eviction rules in your city, in county, right? So if you do have somebody that's not paying, how long does it take to get them out? One of the things we look for in a market is whether it's landlord friendly. I mean, we're landlords, let's be honest. We're responsible. We're using other people's money to buy apartment buildings. We are, it's only responsible for us to invest in landlord friendly places. But landlord friendly can mean very different things. We have an apartment building in Atlanta, and it can take 9 weeks, 8 to 10 weeks to evict somebody who's not paying rent. We also have an apartment building in Tucson, Arizona. It takes 2 weeks.
Wow.
To evict somebody. And those are both considered landlord friendly states. Now, some places it can take 3 months, 6 months, 9 months. I mean, that's just terrible. Can you imagine if you had a single family house and it could take 9 months to get somebody out of your place? So you really do need to understand what are the eviction rules, and then again, understanding bad debt, because it's market data that you have access to, because you're not going to make your numbers if they're not paying. So the other stuff we look at, of course, are related to, so related to income. We're looking at what are the potential rents. We're looking at what is the vacancy rate for the area. What is a normal vacancy rate? We're looking at bad debt, and we're looking at something called concessions. And concessions are how much do you have to give away to get somebody to rent from you. So a concession would be, hey, first month's rent is free if you rent from me. So it's a sign of a market that might be overpopulated with a lot of vacancies, or maybe there's a lot of new construction that just came in. So having some amount of concessions is normal, but a market that has too much concessions is something to be concerned about. So those are all things on the income side. Now on the expense side, you want to be looking at the type of building it is. What are your utilities? What is the vintage of the building? That's the year. What year is the building? So is it, for example, a 60s building, a 50s building? Is there going to be plumbing issues, leaks, things that you're going to have to deal with water? So you're going to look at your utilities and how is that going to be affected? Lots of things and expenses, of course, repairs and maintenance. How much is it going to take to keep this place in good shape? And some of that you can control by the cost of labor, and some of it has to do with the age of the building and stuff like that. So we all know labor cost is going up right now, and the cost of materials is going up right now. This is definitely a concern for many of us. I mean, it must be a concern for you, Danny. Is that something you're facing as well? Concerns?
Yeah, somewhat. I mean, it's not drastic, but yeah, just keeping an eye on what it's costing to have everything done.
So, are you having issues with labor going up in your area?
It does, but not enough to be a huge problem just yet. I mean, San Antonio's got a lot of cheap labor.
That's good. We have big construction projects in different markets, and it's definitely a concern if you have an 18-month project. What labor is going to be.
Yeah.
So let's see. Some important things about underwriting that you need to understand is you need to understand the cap rate, the capitalization rate of the market, because when you're buying something and you're holding it for a while, you buy it at one cap rate, and then you're going to be selling it in the future at a different cap rate. The way that we know how much a building costs or is worth in commercial real estate is we divide the net operating income by the cap rate. Okay. And so the net operating income is you take your income, you subtract your expenses, you don't include debt in it, just your income and your expenses. That's going to give you your net operating income. You divide that number by the market cap rate, and that's how you know what the building is worth. So it's quite different from residential real estate in that sense. And that's one of the reasons I love it, because you have total control over the income and expenses. You don't have as much a control over the market cap rate, but it's a lot better than having no control on the residential side. So you do need to understand the cap rate when you're underwriting, and what cap rate you're going to use when you're determining what your exit will be. So those are some of the highlights of underwriting. I guess I would add one more thing to it that's a really important thing in underwriting is what are your assumptions? So we know, we might know, we know what we're making assumptions about what the market rent is, right? How much are people willing to pay if I give them a nice unit? Some of the other things that you have to make assumptions about is how much is rent going to increase every year? So we know what it increased historically, but what am I going to bet that it's going to increase over the next few years? Some people are very aggressive in their assumptions, and some people are very conservative. Some people might say 4%, some people 5%, some people are going to say 2%, and that's going to really change your underwriting. Same thing about expenses. What is the growth in expenses? Because expenses, of course, are going to grow.
Yeah.
So those are some of the assumptions that you have to think about when you're underwriting, and how are you going to underwrite certain markets. If you're overly conservative, then you'll never find any deals.
Right.
And if you're overly aggressive, then that's not good as well. So we like trying to strike a nice balance based on experience. And then the other thing is, again, once we buy the deal, then we've got to hold our underwriting accountable in the budget afterwards. So then we're looking at, when we're running the building, we're saying, hey, we said that we were going to be able to renovate these units for $4,500 per unit. So we can't go spending $6,500 per unit to renovate, because that's not what we said.
Right.
Or if it does turn out that it's $6,500 a unit in reality instead of $4,500, then we've got to change something else, because we can't just magically, it's not going to work if we do it. So you have to hold your underwriting accountable all the way through the life of the project, because that's, I think, something different as well. And that's when you are using your asset management and your team to stay on top of the numbers.
Nice. Yeah. And I love how you said you don't even look at underwriting until the market analysis is done. And, that kind of hit home for me, because when you're talking about, what are the rent, what's the rent appreciation? What's the expense appreciation? Like, how is that going to look? And obviously you can look at historical things, but if you can't, like 10 years from now, that could go up and down across the board. So how do you make sure that doesn't go wild? And that's the market analysis, right? Because that's a little bit harder for those numbers to fluctuate so much.
That's right.
And it's going to help whether there's going to be more stability in what you're looking at, right?
Yeah, there's always going to be fluctuation, but if you're in a better market, you will better be able to weather the ups and downs. If you're in a market that has poor jobs, poor population, then it's already scraping the bottom, and it doesn't have any forgiveness to give. But if you're in a market that's on the ups, if you've got the wind is behind you, then you can make mistakes. And we all make mistakes, right? We all are doing our best, but mistakes will be made. Right. And there's no forgiveness in a market that is scraping the bottom. Yeah. So you really want to position yourself the best you can by being in the right market. And that's the first thing you got to do. Awesome.
All right. Well, that's a lot of great information. I really appreciate you being on the show. And is there anything else that you'd like to share with the audience before we end the show?
Sure. If anyone's interested in learning about how to buy apartment buildings and how to do more market analysis, we have a lot of free content on multifamilyu.com. I teach underwriting once a month there. We also have a boot camp we teach quarterly, but there's a ton of free information out there as well. We have lots of information about loans, and we host webinars every week. Now, not only that we do, as well as we bring on lots of other experts. So come join us and learn some more about commercial real estate. And even if you are flipping or wholesaling, I think there's a lot to be learned about commercial real estate and market analysis and, funding and all kinds of stuff at multifamilyu.com.
Great. Well, thank you so much, Anna.
Yeah, thanks, Danny. It's great being here with you.
Great. All right. Well, have a great afternoon and keep in touch.
All right. Take care.
Bye.
Bye-bye.